Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Sable Offshore.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, it really helps out.
It really does. So I want you to imagine stumbling across this pristine, multi-billion-dollar factory right in the middle of the desert.
Okay, I'm picturing it.
The lights are completely off, the doors have heavy padlocks on them, and this place is burning through like $500 million a year doing absolutely nothing.
Just burning cash.
Exactly. And that is essentially what we are looking at today with Sable Offshore. I mean, here's a company reporting zero revenue, maintaining this staggering $1.7 billion valuation, and they're currently locked in this wild geopolitical battle to finally flick the master power switch back on.
Yeah, I mean, it's a textbook financial anomaly.
Right.
You're looking at an asset that just completely defies standard market logic in its current state. It's being propped up by these high-stakes regulatory maneuvers, and suddenly, this massive macroeconomic desperation for supply.
It's wild.
It is. So we're pulling together the detailed financial analysis, technical market momentum data, and some fresh sentiment scoring to really decode what the market is actually pricing into this stock right now.
And right at the top here, we definitely need to establish a crucial ground rule for how we're unpacking this for you today.
Oh, yeah. Very important.
Because the data we are looking at includes some highly politically charged developments. Specifically, we're talking about recent interventions by the Trump administration.
Right.
And we want to be crystal clear. We are looking at these events strictly through the lens of the market. We are impartial observers here. We're reporting on these actions solely as market catalysts and variables.
Exactly. No political sides being taken here.
None at all. Our only objective is analyzing how these specific political levers are, actively moving the financial needle.
Because in the capital markets, policy is simply another data point. That's it.
Just data.
Executive orders, federal directives, regulatory shifts, they're all just weighed and measured exclusively for their mathematical impact on asset valuation and project timelines.
So let's look at the sheer scale of the financial paradox we are dealing with here.
Well, good.
Sable Offshore currently boasts a market cap of $1.77 billion.
Swoosh.
It's trading right around $16.83 per share, with about 147 million shares outstanding. But, and this is the crazy part, their full-year net income is a jaw-dropping negative $629.07 million.
Wow.
On exactly $0 in revenue.
Yep.
Because, just like that dormant factory analogy, they produced absolutely nothing.
Yeah, and that $500 million crater represents what analysts call the pre-production valley. But even for a pre-production asset, the depth of this cash burn is just extreme. I mean, if you isolate just the most recent quarter, they posted a net income loss of $128.07 million.
Just in one quarter?
Just one quarter. And that actually represents a 16.91% widening of their loss from the prior quarter, which, sat at negative $109.4 million.
Okay, let's unpack this. Because a standard company burning $128 million a quarter with zero product, they don't get a $1.7 billion valuation.
No, they definitely don't.
They get liquidated by their creditors. Right?
Yeah.
Honestly, it feels like we're looking at a late-stage biotech stock, not an energy company.
I think that's a really good comparison, actually.
Like, you burn $1 billion in clinical trials with zero revenue, solely banking on the FDA finally stamping the approval. The market isn't valuing the current sales. It's valuing the monopoly waiting on the other side of the red tape.
That biotech comparison is the exact framework you have to use to model Sable Offshore. The market does not view that negative $128 million as, operational bloat or wasteful corporate spending.
So what is it?
They are forward pricing, heavy pre-production capital reinvestments. They're putting this into massive, tangible, physical assets.
I see.
This isn't money just vanishing into thin air. It's capital being intensely deployed to ensure that when that regulatory green light finally comes, the machinery doesn't catastrophically fail on day one.
Which means the burn rate is actually a symptom of preparation.
Exactly.
Because when an offshore facility sits dormant, you can't just walk away and leave it to the saltwater. You've got, what, structural integrity maintenance.
Right, constant pressure testing on the subsea pipelines.
And relentless environmental compliance checks, I'm sure. So the cash bleed is just the unavoidable price of keeping an ocean-based asset in a state of immediate operational readiness.
Because the alternative is letting the infrastructure degrade.
Hmm.
And that would make a future restart completely unviable. The market understands this necessary burn. And crucially, they are finally seeing the absolute first flicker of that machinery waking up.
The lights are turning on.
Exactly. In the last reported quarter, revenue actually ticked up to $1.50 million.
Okay, I mean, $1.5 million is essentially a rounding error for a $2 billion company.
Pretty much, yeah.
But it exceeded the $0 consensus estimate, so it's a massive psychological trigger for investors. It's basically proof of life.
Right, it proves the internal mechanisms are actually beginning to turn. But the actual valuation anchor, the massive catalyst holding up that $1.77 billion market cap, is their forward guidance.
What are they projecting?
They are officially projecting $39.84 million in revenue for the next quarter.
Oh, wow. Okay.
Yeah. That tells the street the pre-production valley is abruptly ending and an imminent large-scale production ramp-up is underway.
But, and I have to push back here, you can't justify a multi-billion-dollar valuation purely on the promise of $40 million in revenue next quarter.
Fair point.
The underlying asset has to be virtually irreplaceable to command that kind of patience from institutional capital. So what exactly does Sable Offshore own that makes this dormant setup so incredibly valuable?
Well, they own exclusive control of the Santa Ynez Unit.
Okay, what's that?
It's this incredibly prolific offshore oil and gas field located in federal waters off the coast of California. And the sheer physical footprint is staggering.
How big are we talking?
We are talking about 3 established massive offshore platforms, an extensive, fully integrated network of subsea pipelines, and 16 federal leases spanning 76,000 acres of ocean.
76,000 acres.
Yeah.
That is an enormous footprint. But the real value here isn't just the hydrocarbons sitting underneath the ocean floor, is it? It's the fact that nobody else is ever allowed to build a rig next door.
If we connect this to the bigger picture, the regulatory environment in California has created what is arguably the deepest competitive moat in the global energy sector.
Right, because California is notoriously strict.
Extremely. They haven't issued a new offshore drilling lease in decades.
Wow.
Decades.
Yeah. So a greenfield competitor, companies like Noble Corp or Seadrill who build new offshore developments, they aren't just fighting for complex engineering permits.
What are they fighting?
They are fighting an entrenched, codified, anti-drilling legal framework at both the state and federal level.
It's like owning a massive rent-controlled penthouse in a city where zoning laws have made it literally illegal to build any new high-rises.
That's a great way to put it.
The value isn't just the oil, it's the impossibility of a competitor ever replicating their setup. You're dealing with the California Coastal Commission, state environmental mandates, and decades of legislative blockades. It's an impenetrable shield.
And that physical infrastructure already sitting in the water. It drastically lowers Sable's restart costs compared to those greenfield competitors.
Obviously, yeah, the heavy lifting is done.
Right. But more importantly, it protects against rivals because of the incredibly high switching costs and those immense regulatory hurdles we just talked about. So the moat is physical and legal.
Exactly. The established physical assets act as a fortress. The market is pricing in a mature asset operating within a regulatory monopoly where new market entrants are functionally illegal.
Okay, that perfectly explains the long-term value of the fortress.
All right.
But if this impenetrable physical infrastructure has just been sitting there all this time, what is driving this frantic, high-stakes urgency to get it online right this second?
That's the real question.
Right. Because the narrative in the data suddenly shifts away from this static physical infrastructure to these explosive, almost chaotic macroeconomic and political catalysts hitting the stock literally this month.
Well, the urgency is entirely external.
How so?
We're looking at a macro landscape that is heavily disrupted by ongoing conflicts in the Middle East.
Okay. The geopolitical angle.
Yeah, that geopolitical instability is creating acute top-down pressure to secure domestic U.S. offshore supply. The federal government is looking at the global supply chain and realizing they need reliable domestic energy online immediately to hedge against foreign disruptions.
And that macro pressure brings us to a catalyst calendar that reads more like a political thriller than a standard earnings report.
Seriously, it's wild.
We are centered right around this month, March 2026. On March 13th, the Trump administration issued specific, aggressive directives to resume operations at the Santa Ynez Unit.
Right.
And even wilder, on March 11th, there were unconfirmed rumors circulating that the administration might invoke Cold War-era emergency powers to literally force the permitting process through.
Yeah, the speculation around utilizing mechanisms like the Defense Production Act or, similar executive emergency powers, that is what drove the massive volatility we saw in the stock.
I mean, that's huge.
We're talking about federal mechanisms designed to compel companies to prioritize national security needs. They're essentially attempting to bypass standard, localized, regulatory red tape.
To just force it open.
Exactly. It is a level of federal intervention rarely applied to a single corporate asset.
Here's where it gets really interesting for you, listening at home. You have analysts completely split on how to price a stock that's being driven by emergency federal rumors.
Very split.
On March 14th, Seeking Alpha issued a strong buy upgrade on the stock, largely based on these production restart catalysts. But just a week prior, on March 6th, Benchmark actually issued a downgrade.
Yep.
The institutional mood is being described as mixed bullish, which is giving retail investors absolute whiplash.
It is a total tug-of-war between technical momentum and headline risk.
Right.
The stock surged aggressively on Wednesday the 11th on the news of the potential permitting ease and executive intervention. But analyzing the raw price action only tells half the story.
What's the other half?
You have to look at the quantitative sentiment scoring across the major financial news feeds to really understand where capital is actually flowing.
But how does a retail investor evaluate a stock whose momentum seems completely dictated by political rumor mills? I mean, it feels less like investing and more like betting on the news cycle.
You look at the aggregate data. When we analyze the sentiment scoring, a really clear pattern emerges.
Okay, what's the pattern?
Out of the top 5 most impactful stories driving the stock right now, 4 of them are leaning heavily bullish.
Oh, wow. 4 out of 5.
Yeah. Algorithmic sentiment scoring measures the tone and impact of financial news, and a 4 out of 5 bullish ratio shows a definitive market bias.
So the market is making a definitive choice here. They are weighing the federal urgency for domestic supply much heavier than the standard, localized, regulatory red tape.
Exactly. The volume spikes around these headlines suggest that capital is heavily positioning for a successful production catalyst.
They're buying into the restart.
Traders are betting that the macro need for oil, backed by the sheer weight of federal executive power, will ultimately bulldoze through all the local obstacles.
Well, traders might be betting on federal bulldozers, but those bulldozers just ran into a massive judicial brick wall on Friday.
They sure did.
The stock dropped significantly, and it wasn't because the platforms rusted over, it was because of the courts. Every bull run has a hurdle, and Sable's relies heavily on the judicial system.
Yeah, the Friday sell-off was directly tied to revived pipeline fights in the judicial system.
What happened exactly?
A judge ordered new disclosures from the Trump administration regarding the permitting process.
Ah.
And when a stock's entire momentum is predicated on a hyper-accelerated, federally mandated timeline, any procedural delay, even just an order for more paperwork and disclosures, is fiercely punished by the market.
But look at their history, too. This isn't the first time investors have been promised a restart.
No, it's not.
If we look back to last year, spanning May to June of 2025, there was a major class action lawsuit filed against the company, specifically alleging false restart claims.
Right, the credibility issue.
Yeah. So if I'm an investor, why shouldn't I look at this new $39.84 million revenue projection for next quarter as just another mirage? They've promised the switch was flipping before and ended up in court.
And that trust erosion is a very real, tangible drag on the stock. When management loses credibility on timelines, the market demands a risk premium.
Naturally.
The historical baggage of the 2025 lawsuit means investors are hypersensitive to any legal friction right now. However, the analysis indicates that the broader market currently views these specific Friday court delays as transient.
Transient, so they are pricing them in as speed bumps, not impenetrable brick walls.
Exactly. The overarching thesis holding up that $1.77 billion valuation is that federal overrides can and will manage these local pipeline fights.
They believe the feds will win out.
Right. The regulatory tailwinds, which are driven by that global supply gap and geopolitical urgency we discussed, are currently viewed as strong enough to mitigate the historical baggage. The market believes the federal mandate ultimately carries way more weight than a regional court injunction.
So what does this all mean?
Let's sum it up.
If we take all of this, The massive financial losses, the impenetrable competitive moat of the Santa Ynez Unit, the wild geopolitical catalysts, and these looming court battles, and we distill it down into an elevator pitch. What is the ultimate takeaway?
The elevator pitch is essentially this. Sable Offshore is currently viewed as undervalued at its current price of $16.83.
Okay.
It is armed with massive moat-protected physical assets in a California market where new competition is legally and physically impossible.
The fortress.
The fortress. And, driven by unprecedented federal directives and macro supply gaps, it is primed for a production-led re-rating.
A re-rating meaning the market will finally value them as an active cash-generating producer rather than this dormant cash-burning project.
Exactly.
And for you, the listener, the actionable takeaway here is the target horizon. The data highlights this as a swing trade strategy leading directly into the Q1 2026 earnings resolution. So we are looking at a highly critical 1 to 3 month window.
That time frame is the ultimate proving ground. I mean, in the next 90 days, that projected 39.84 million revenue inflection point is going to be tested.
It's make or break.
Completely. It'll either become reality, triggering that massive re-rating, or it will be bogged down by the courts again, testing investor patience to its absolute breaking point.
It is a crucible moment for the company, without a doubt.
It is. And it brings up a crucial final thought for anyone analyzing this situation to ponder independently.
What's that?
We've established the incredible, irreplaceable value of the Santa Ynez Unit's physical assets. But right now, the company's immediate path to profitability relies extraordinarily heavily on unconfirmed Cold War-era executive emergency powers to bypass standard regulatory approvals.
Right. They were relying on a political sledgehammer rather than a standard set of keys to open the factory doors.
Which raises an important question.
I'm listening.
When a company's immediate viability is so deeply tethered to specific, aggressive political interventions, how should an investor value the long-term safety of those physical assets if the political winds suddenly shift again?
Wow. That is the multi-billion-dollar question. Because a massive dormant factory is only as valuable as your permission to turn the power on.
Precisely.
And if that permission is granted through political loopholes rather than permanent regulatory ink, the ground beneath that 76,000-acre empire might be a lot less stable than it appears.
Exactly.
Definitely something to chew on as you watch this 1 to 3 month window unfold. Thanks for joining us on this talk.